Good evening, everybody. Thank you for taking the time to join me this evening. I am Ryan Herbert. We're going to go ahead and get started here. I encourage you guys to kind of ask questions as you go. If you have questions, there's a little box down towards the bottom where you can type in a question. And I believe there's also a raise your hand feature, but it's easier if you just type your question in, and I will try to address the question as I see them. So I'm going to go ahead and start here. This is an old photo. We had some newer photos taken, but we haven't used them yet. Some of the newer team members of our team, their faces aren't shown clearly enough. So this is the one I've been using for the past. Everybody knows Mike. That's me. This is pre-COVID, before I had the beard that I have now. Just some places Mike and I have always been published. You guys have seen this. I think all of our clients, and those of you who are joining us who are not clients, you might have heard us before on 105.7 The Fan or 680 AM in Baltimore, and then we're on 2 or 3 different channels down there in Florida as well. This is informational purposes. Past performance doesn't guarantee future results. Really, that's kind of what that disclosure is there for. Really, this is just kind of what Mike and I are thinking about what's going on in the markets. These are factors that we consider when we talk about the technical and fundamental indicators that we look at. This is really kind of what we're looking at. There is also that momentum factor to all of the portfolios that we put into the portfolio in 2019, 2020. Those are a little bit harder to kind of explain, so I really just stick to the technical and fundamental analysis side of things for the purpose of this conversation. So, the one thing, the big thing is that everyone got the new financial planning agreements. Everyone got the new fee agreement sent out to them in December. If you did not receive it or you have not sent it back in yet, please send us those agreements back in. And if you did not receive it, please give the office a call. And if you have any questions about it, feel free to also give the office a call, and I'd be more than happy to have that discussion with you guys. The new trading platform that we talked about, that Mike talked about in the webinars that he did back in December, is up and running, and that's what we're using, where we're doing these orders for the portfolios. We're placing these buy and sell orders for the portfolios, and it is doing all of the orders in one bulk order versus breaking it up as the old system used to. So it's up and running, and Mike and I are very pleased with it. So if you have not done so already, please return the updated fee agreements, and also please return your 2022 financial planning agreements. Okay, hold on one second. Is this any better? Michael, can you hear me? Let me audio. Let me switch. Okay. I think maybe now everyone should be able to hear me. Let's see. Okay. So I just switched off of my phone onto the computer microphone. If you're having problems hearing me talk, let me just pop this one thing out here. I suggest, I guess you can't hear me,
So, as I said, please return the updated fee agreements and the financial planning agreements as well. So, one of the big questions that I've been trying to address that's been coming up kind of towards the end of the year here is, will 2022 really be any better than 2021? You gotta excuse me here. I'm just trying to rearrange some things on my screen so I can see my notes here. There are signs that this new year will be better than the last. The direction of the variants of COVID-19 and really what happens is difficult to predict. But the other recent fear really for the markets has been inflation. We saw that 6.9 inflation rate last year, but that really may be about to ease. The Treasury bond markets have been sending this message to the Federal Reserve that it may not have as much scope as it thinks to really raise the short-term rates as the forecast suggests. Congress has reached a deal now that has postponed any debt ceiling issues to 2023, so that's nothing that we really need to look at. Really, we believe that 2022, as I said back in October, 2022, we believe that the global economic environment is still going to be favorable for investors. The central banks all over the world really are preparing to rein in the pace of their stimulus. This is really showing us what we think the major economies with GDP numbers that are either going to grow and accelerate, grow and decelerate, contract and accelerate, or contract and decelerate. And really, we think that there is going to be growth. One of every 45 major every one of the 45 major economies in the world will be growing next year. With about half of them, that's what we're seeing here, about half of them experiencing slower growth. The big thing there is that there is going to be growth. We foresee growth going forward. Investors really are looking forward to easing in the pressures that really have kind of messed up the economic outlook in 2021, that inflation included. Really, we saw a lot of the volatility return there in the last 2 months of the year. Consumers have not reined in their spending. U.S. sales increased by 3% in November, the fourth monthly increase in a row. December obviously is going to be another good month because of it being the holiday season. The number of U.S. consumers that are thinking about making big major purchases over the next 6 months really stays kind of low. What you can see here is that the consumer price index has increased. It's been increasing all last year. Here we really saw this. It increased at 6.8, the fastest rate we've seen since 1982. The consumer price index components that are really associated with the reopening of the economy after COVID-19, we have car prices. Those prices have skyrocketed because of supply and demand. We have airfare. That went up because less people were traveling. Those really are the bigger contributors to the overall inflation that we've seen throughout the year. In the second quarter of the year, prices surged mostly due to supply chain bottlenecks, and that's kind of what we talked about. The resurgence of these bottlenecks really is saying that we are not yet out of the woods with the supply chain. A lot of where we saw increase in prices was in used cars and trucks, rental cars and trucks, vehicle insurance. People are driving more instead of flying. Hotel, lodging, prices of that went up because less people are staying. They need to increase their prices to remain profitable. Airfares, and then people eating food away from home, that really went up. So, we've seen this increase of inflation, but we think that this rate is going to start to fall off over the next year or so. The fears about inflation really have been telegraphed pretty well by the consumers. This chart that we're seeing here. This is a 5-year over 5-year US dollar swap rate, which what it's saying is it measures the expected inflation rate over the next 5-year period. And that really begins 5 years from today, really has started to fall down from its high. That's this blue line here. We hit this peak of 2.6 midway through the year. Now we're really starting to kind of fall down from that mark. Another measure is the University of Michigan study that they do. It says that consumers expect inflation to settle right around 3% over the next time frame, which is pretty substantially lower than the current rate of 6.8. Both of these metrics really are very well below where we saw the 5-year over 5-year rate back in 07, 09 during the global financial crisis. Really what we see is, supply-related factors really have been driving it. People feel that the supply chain issues are going to they're going to slowly resolve itself, so inflation should start to tick back down. That's kind of the bottom line from this particular slide here. Certain segments of the stock market have started to take notice of the possibility for higher prices and higher interest rates in the future. A big thing that we saw happen was the run-up of our meme stocks, our non-profitable tech stocks. Really we saw this massive run-up in a lot of those positions through the year. It really peaked January, February, and it has fallen off. It started a little bit of resurgence, but really over the past month or so, we have seen it fall back. The beginning of 2020, their lead over the more fundamentally sound tech stocks has been cut to just over 50%. The narrowing of this gap, the performance gap between these particular two types of tech stocks really is showing we want to have high quality factors for the positions that we're holding. You don't want to just try to swing on these big meme stocks. Really, we're seeing kind of a rotation into more normalcy in the market, not this craziness that we saw from April, May of 20 to the early part of 2021. Global markets, they have hit their peak as far as inflation goes. Inflation in the EU surged to 4.9% in November of last year, which was the highest in the 23-year history of the EU. Once again, really is a result of the supply chain issues. It not only affected the United States, but it affected all over the world. The market is pricing in the fact that it thinks the European Central Bank is likely going to put a rate hike in 2022. The inflation, as it's being predicted, should once again, in the United States, we're anticipating about a 50% drop in inflation, should drop by year end, likely somewhere below 2%. So once again, almost a 50% reduction in what we're seeing, because investors and consumers are anticipating the easing of the supply chain crisis over the next year. A lot of what has driven inflation in the EU really has been energy prices. Energy prices contributed to about 2/3 of the increase of inflation that they saw right here. It's kind of what happens with energy prices is really going to determine what happens with inflation in the EU. Like I said, I think that the European inflation is going to fall from around 5% down to right around 2% by the end of the year. Really kind of what we want to happen with energy prices. This is kind of this is our inflationary measure right here. That's the rate of inflation, and here is energy. You can see the biggest increase that the EU saw as far as consumer prices go was in energy. We have non-energy industrial goods. We have food, including alcohol and tobacco, and then their charges for services right here in the green. Hopefully energy prices over there stabilize. If that happens, we should see, like I said, a drop right around 2% to their inflation. If energy prices fall back down to pre-pandemic levels, their inflation will really tumble pretty low. I don't think that is really going to happen, simply because companies have gotten consumers used to these higher prices. I don't think that all of a sudden, if the supply chain issues go away, these companies are going to reduce their prices. I think they're going to keep their prices high. I think that what's going to happen is they're no longer going to increase their prices for these goods and services that everybody needs. One thing that people get concerned about when it comes to inflation, especially in the United States, is, big government spending programs boosting inflation. Well, the EU differs from the United States in this manner. They don't do a lot of large government spending programs. The inflation fears over in the EU have really started to peak. The ECB is saying that it does not want to raise interest rates too quickly because they don't want to kill what's going on in the market over there. I don't expect any quantitative easing in the EU to end next year as well, so I don't think that's going to cause a crisis. I think that really we're going to see some continued growth out of the US markets as our inflation fears come down. Same thing over in the European economy as well. The dominant trend in what we've seen in the Treasury market over the past few months has been the flattening of our yield curve here. What that means is the narrowing between how much you can get, how much interest rate you can get on a 3-month, 6-month Treasury versus a 10-year Treasury or a 20-year Treasury. Short-term interest rates have been moving nominally higher over the past couple months here. Really anticipating the Federal Reserve is going to start raising that Fed funds rate. But the issue there is that the long-term rates have not risen as well. Really what we're seeing is that there's not a lot of difference if you put your money away for 2 years and buy a Treasury versus if you put your money away for 10 years. That is an issue. What we don't want to happen is that inverted yield curve, meaning you get more money for buying a 2-year Treasury versus buying a 10-year Treasury. Typically, we see this flattening of the yield curve. Typically, when there is the Federal Reserve is in a tightening cycle, really what's happening is we're waiting on the Fed's true decision on whether or not it's going to taper its bond purchases. Stop buying so many of the U.S. bonds and letting the overall U.S. consumer buy. That is kind of what we're waiting on at this point. Once again, this is kind of the global 5-year over 5-year looking expectation rate. What we're seeing is that investors really are anticipating slower growth in the U.S. economy, slower inflation under a tighter Fed policy. As the Federal Reserve pulls back on its very easy policy it's had over the last 2 years, the markets seem to be saying, okay, that's fine if we're going to do this. Growth is going to slow down, but we're also going to get lower inflation. What we notice is that the trend is really suggesting that investors are concerned that the Federal Reserve could make a policy mistake, possibly by tightening too fast or too soon. Really what we're seeing is we had our peak in October for the 5-year forward-looking inflation rate, where we think inflation is going to be 5 years from now. We peaked in October, and now it's fallen back down right around 2.1, 2.2, which is consistent with where the Federal Reserve wants inflation to be. So the U.S. consumer, the overall consumer, thinks inflation is going to start coming down here shortly. And really, the quantitative easing, the Fed buying these bonds is supposed to end in May. That's kind of what they've said. Possibly they can end it in February if they double what they said they were going to do in December. The Fed is still, them buying these bonds is still supporting the market, and that is going to keep the rising rates, them raising rates. The longer they buy the longer they buy these bonds, the longer it takes for them to raise interest rates. The Fed has started to taper off these purchasing because they want to start raising interest rates. Really what they are trying to do is to reduce its rate from $30 billion a month of purchases compared to $15 billion. Right now, the Federal Reserve owns 25% of U.S. debt. If they reduce what they want to do, reduce their bond buyback, they should complete its quantitative easing by the end of the first quarter. That's what I said here, May of 2022, May of this year. That's when we should start to see, hopefully, a rise in interest rates. Really kind of what we're seeing here is, the longer term prospects for higher bond yields in other developed countries like the United States are limited. The interpretation of that flattening curve, that flattening yield curve, really means that the markets are seeing limited upside potential. The markets don't think that rates are going to be very attractive anytime soon. It's not going to make sense to put your money away for 1 year, 2 year, 3 years buying government bonds because they're not going to give you these higher interest rates. The market feels we are going to be in a low interest rate environment for the next couple of years. The Fed is saying they want to get to 2.5% by the end of, by end of 2024, mid 2025, where really the market is saying, yeah, I don't think it's going to go that. I think it's going to, the market feels it's going to be a higher initial rate, but then it's going to take much longer for us to get to that target rate of 2.5. Really what that means is the strategy that we have been using as far as the bond replacement, using the products from security benefit or Athene or North American, that strategy still holds true, because having your money in bonds while it's paying at the current moment very, very low rates doesn't really make sense, because if the Fed starts to raise the rates at which they want, those low yielding bonds are not really going to give you any money. Really, what's going to happen is you're going to lose your value on those bonds. So, really what we have here is, we have a scenario where if we have inflation start to fall off, we should see continued market growth throughout 2022. It's not going to be as rapid as we've seen over the past 2 years, certainly nothing like 2020. 2021 was a good year. The portfolios did really, really well last year. Interest rates are still very low. We remain light on bonds, from traditional bonds from that nature, because of the interest rate environment, because the Fed wants to raise their rates. It's just a matter of when they're going to do it. I didn't put anything in here about the Build Back Better bill, proposal, whatever you want to call it. Really, the approach that Mike and I take to policy of that nature is kind of a wait and see approach. There's been talks of raising taxes, changing around the estate taxes, and the approach we have is a wait and see approach. We just want you guys to know that Mike and I are we are thinking about strategies we can implement if they change the estate tax rates. We're thinking about strategies we can implement if they raise taxes, strategies we can implement if this Build Back Better program comes through in its current manner, or whatever iteration it actually becomes. We think now more than ever, Roth conversions, really, we have 4 whole years to finish Roth conversions at these lower rates. That's what the current laws say right now. The current Trump tax rates expire at the end of 2025. After that, we go back to the Bush level, where we see significant increases in the 22, 24, 27% bracket range. Those all jump up pretty significant. So the time is now to make sure we get those Roth conversions taken care of by the end of 2025. That really is it for me tonight. I hope everyone had a enjoyable holiday season and enjoyable new year. I hope everyone is staying safe from this new COVID variant. If you come to the office, or you've been to the office, you see that we have asked everyone to please wear a mask again at this point. Kind of following what Anne Arundel County is saying that we should do at this point. But for the health and safety of our staff, our families, and our clients and your families, we do ask that everyone wears a mask. Tax season is upon us. We will be offering face-to-face tax appointments for our financial planning clients this year. If you are a financial planning client, you should be receiving a letter in the next week or so, really detailing what your options are for tax preparation this year. Once again, I want to thank everybody for attending. I want to thank everybody for being our clients. Mike and I really cannot do what we do without you guys, and we really appreciate you. Thank you, everyone, for attending, and I hope to see everyone in the office over the next couple months here for tax season. Thank you, and have a good night. And if you have any questions, please feel free. Give me a call at the office, 410-863-1040, or shoot me an email. I believe everyone got an email from me reminding you to attend our presentation tonight. Thank you, and have a good night.